You are watching Notepad. I'm your host, Ibrahim Sani. The episode for today will focus on the palm and lauric oils conference that was carried out by Bursa Malaysia Derivatives midweek. But of course, the POC 2020 for this year, for the first time ever, it's done virtually. So hence, it's branded as Virtual POC 2020 Palm and Lauric Oils Price Outlook Conference and Exhibition. There's Dr. Julian McGill on what is the direction of the palm oil as well as major oils direction, and whether or not the kind of outlook for this sector is going to be favorable or otherwise. So here is that session. I hope you enjoy it. Let's take a look.
Selamat petang, good afternoon, or good morning, depending on where you're joining us from. My name is Julian McGill, and I'm an economist at LMC International based in our Kuala Lumpur office. I've called the slide in front of you right now the palm oil price rollercoaster. The diagram depicts the crude palm oil price in Malaysia, based on Bursa Malaysia Derivatives' third position, in US dollars per ton since January 2019. Ordinarily, this would not be a very interesting diagram. However, I am sure you can agree with me that 2020 has not been an ordinary year. So I think it's worthwhile at the outset to briefly reflect on the remarkable palm oil price volatility over the last 22 months. So if we go back to what now feels like a very long time ago, to January 2019, we can see that at that point, the palm oil price was around $550 per ton, and that for the next half year, it drifted gently downward. There was a malaise over the plantation sector. Despondency had gripped many plantations. Some were even facing bankruptcy. By June, however, it became apparent that the usual seasonal droughts in Indonesia were likely to be more prolonged than in previous years. When in the more drought-prone regions of Indonesia, such as Kalimantan and southern Sumatra, by September, and even some cases October, the rains had still not arrived, prices began a rapid ascent. Funds, speculators, were believed to have a hand in pushing up the prices. And in fact, Chinese funds in particular were believed to be behind a large amount of the price increase. Indeed, it was just before Chinese New Year, in January 2020, that prices began to soften. And it was rumored that this was due to the fact that the Chinese funds wished to pay Chinese New Year bonuses to their traders and therefore liquidated their positions. But of course, around Chinese New Year was also when COVID-19 was increasingly moving to the forefront of people's minds and making markets jittery. Around the time of the reunion dinner, the lockdown in China began in earnest. And of course, from there, lockdowns spread to many countries around the world. The crude oil, the petroleum, price was the first to fall as markets realized the implications lockdowns would have on travel. Palm oil prices, however, also began a rapid decline. In fact, if you look at the diagram, the movements were so fast that it's almost as if someone was trying to draw a triangle. It went up and down almost at exactly the same angle, like a pyramid. Crude oil prices bottomed out by April, when Brent, the North Sea, British petroleum price, hit $19 per barrel. That's about the price of 2 cinema tickets in Oxford. Now you may say that merely means cinema tickets in Oxford are too expensive. But nonetheless, crude oil prices recovered from April, and as lockdowns were released, as citizens came out of lockdown, palm oil prices also stopped their decline. In June, the crude palm oil price rallied on strong export data, but the real shock came in July, when against the usual seasonal pattern, palm oil output in Indonesia did not increase. This pushed the market higher to the point where by September prices had reached $650 per tonne, and by now, by October, we were looking at prices just shy of $700. So by now, prices have returned to almost the same level they were at in January 2019. This is remarkable. We have had a pandemic disrupt everyone's lives, many people's livelihoods, and yet the palm oil price appears to have been immune to this economic chaos. So the question we must ask ourselves is, are these high prices justified? Could we face a large price correction, or will they persist? And over the next 30 minutes or so, we'll look at how we can shed light on this by examining what we view as the 5 main factors currently influencing palm and other vegetable oil prices. Now, the first factor is one with which you will be very familiar: the weather. You can't avoid talking about the weather when you work in agriculture. The diagram in front of you shows you average rainfall in Kalimantan on a monthly basis since January 2019. We're showing you this to illustrate the general patterns in precipitation over the course of the last 22 months. Within Kalimantan, of course, between East, West, Central and South Kalimantan, there are differences in the weather patterns, as well as, of course, within those states. This is just to show you the pattern, the overall pattern. And to help you see it even more clearly, we have included in the grey shaded columns for each month the divergence from the average, from the long-term average. So that's how much did rainfall in that month differ from normal rainfall, long-term average rainfall for the corresponding month. Now, the first period that stands out are June to September 2019. You can see the impact of the droughts there. Rainfall was half, if not 60%, as the level of what it would have been normally in July, August. And these extreme water deficits in many regions had an immediate impact on the oil palms by causing bunch failure, which in turn reduced the yield of fresh fruit bunches and therefore the crude palm oil output. It was also clear that the severity of the water deficits was such that this would have a lagged impact on yield. There was a general expectation that 12 months after the drought, so in June to August 2020, we would see inflorescence abortion and therefore lower output from the drought-strained trees. In addition, we knew that 2019 had seen low prices and therefore lower than usual fertilizer application. And this was likely to reduce yields again with a lag. However, 12 months later, in June 2020, where we had previously had droughts, we suddenly faced floods. And you can see this in the diagram. If you look at the final period on the right, rainfall was much higher than usual for the period. At one point, probably 80% higher than it would have been normally. And this heavy rainfall caused logistical difficulties in moving the fresh fruit bunches to the mills. Very well-informed sources tell us that the conditions on the plantations were particularly poor because the low prices in 2019 had led to less investment in maintenance, which had meant that the roads were less able to survive the onslaught of heavy rains. And as the roads were washed away, it became very difficult to move the fresh fruit bunches as well as the crude palm oil. And of course, this also had an impact for smallholders who often use the roads provided by the plantations. Now, what was the impact of all of this on output? The diagram on your screens now shows you the year-on-year change in palm oil production in Indonesia in green and Malaysia in green since 2000, so for the last 20 years. 2020 is the last point on the far right of the diagram. And what you can see is that our estimate is that Indonesian output in 2020, relative to 2019, will decline by almost 5%. We knew it would be a poor year for palm oil production, thanks to the droughts in the previous years, thanks to the lower fertilizer application. But that was compounded by the heavy rains, which at first simply reduced output, pushing the potential peak later into the year. But as they continued, it reached the point where Indonesian output never had a high peak. Malaysia, on the other hand, has seen output that was very similar to 2019. Now, why has Malaysia had a less decisive impact? Well, one reason for that is the differences in the locations of the plantations. As Indonesian area under oil palm has expanded, increasingly the area has moved further and further south, Kalimantan, South Sumatra, as well as even further afield into Papua. This has meant that the areas have been further and further away from the equator, so in less good areas, less climatically optimal areas for oil palm, but also areas that have very distinct weather patterns compared with Malaysia. So whereas in Peninsular Malaysia the main impact of the droughts is usually in the start of the year, in Indonesia, as we have seen, June, July, August are often the worst months. And that's meant that really Malaysia and Indonesia have become decoupled. Now, there's another interesting point about this. And the reason I've included such a long time series on this diagram is to make one additional point. We have become accustomed to seeing Indonesian output grow at a structurally higher level than Malaysian output. You can see that in almost all cases, Indonesian output is quite a few percentage points higher in terms of growth than Malaysian. This is the first time that Indonesia has underperformed Malaysia. Now, we've mentioned that the reason for that really is due to the different rainfall patterns. But there is another factor in the background, and that is that until recently, Indonesia has had the benefit of quite large volumes of new area coming into maturity. And as a result of these new areas, we have become accustomed to seeing Indonesian production grow year on year by relatively large amounts. That growth has now slowed, as restrictions to new planting, as low prices have meant that the expansion in area has declined. And this means that for the future, even in Indonesia, we are going to rely more and more on yields to determine the output growth. And with, as we have seen, the recent volatility in the rainfall, with the recent climate problems, that probably will mean that in future Indonesian output will be more variable. We cannot expect to see year-on-year growth in the way we have in the past. 2021, however, is likely to see a good improvement in production. And the reason for that is that the oil palm is very sensitive, as you well know, to rainfall deficits. And with the La Nina this year, that means we have almost certainly not had a problem of insufficient rain. So next year, the oil palm should not have a lagged effect from any droughts from this year. Though, of course, there will still be some lagged impact from the droughts in 2019. So output has weakened even more than initially anticipated due to the heavy rains in Indonesia. But what about demand? Surely COVID-19 had an impact on demand for palm oil. The diagram in front of you now shows monthly exports of palm oil, both refined and crude, from Indonesia and Malaysia. We split the exports into two groups. The first is exports to China, India, and the EU. In green, those are the three largest import markets for palm oil. And the second line in grey are exports to the rest of the world. As you can see, in general, exports to the big three markets and the rest of the world move in unison. Coinciding with the spread of COVID-19, however, there was a marked divergence. From January 2020, you can see a sharp decline in exports to these three markets. Now, for India and China, the reason for this decline was due to their lockdowns. Both countries had relatively strict lockdowns that meant that people could no longer eat in restaurants or cafes. This particularly hit palm oil demand because it is used for frying and catering. We've learnt a very new, very ugly word this year, horeca, hospitality, restaurants and catering. And that demand declined in particular, and notably so in India. In the EU, the situation was more complicated, as good production in Colombia meant they took a larger share of EU imports, which also meant, incidentally, that Rotterdam prices became increasingly decoupled from Southeast Asian prices, which happens occasionally. Other regions did their best to take the palm oil that was not being bought by China, India, or the EU. African imports in particular were strong as countries reduced import duties and import barriers to ensure food security, fearing disruptions to palm oil supply, which thankfully never materialized. Nonetheless, overall, there was a decline in export volumes of palm oil. For the 3 months of the main lockdown, the consumption of vegetable oils in India and China were probably down between 10 to 15%, though these didn't coincide precisely because India started the lockdown slightly later. Interestingly, though, all of this occurred during a low production period for palm oil. Then, once the lockdowns eased and schools and workplaces reopened, consumption returned. In addition, stocks that had been run down in China and India needed to be replenished. And as you can see on the diagram in front of you, exports to India, China and EU, the green line, surged from June onwards. At that point, India, incidentally, also started buying from Malaysia again. There was a slight détente over the political fallout. And with Malaysia having very good production in June, this also supported export volumes. So are we now back to normal levels of demand? Has all the disruption from COVID-19 now passed? Well, in many parts of the world, Malaysia included, a large share of the workforce is still working from home. Restaurants and cafeteria sales of food remain lower than previously. As a result, more vegetable oil sales are now directly to consumers than previously. And there's also been a shift towards smaller retail packs, away from larger retail packs. In some ways, though, this has been beneficial to vegetable oil sales because consumers, home consumers, reuse their oil less frequently. So they buy oil more often, actually, than the horeca users. And overall, therefore, well, the pattern of demand remains very different from prior to COVID-19. Consumption is back to approximately the same level. But of course, food use is not the only use of vegetable oils. What about biodiesel? What are the ramifications of COVID-19 on biodiesel demand? Well, one of the main impacts of lockdowns was to stop people traveling. And this, of course, had a strong impact on petroleum demand. The diagram on the left in front of you now uses US data to look at the year-on-year change in weekly petroleum demand, split by the three main products, gasoline, diesel, and jet fuel. And what you can see is from the start of the lockdown in the beginning of March in the US, demand for petroleum products declined dramatically. The most obvious was the decline in jet fuel as flying became difficult, if not impossible. Gasoline also declined as people drove less. Diesel consumption declined, though not quite as dramatically as the other two, and this was mainly due to the fact that diesel, of course, is used a lot in heavy goods vehicles, which continued to do deliveries throughout the lockdown. Now levels are almost back to normal. They're not quite, and of course jet fuel demand remains much lower than previously. And the reason this matters, of course, is because most biofuel demand is set as a share of total transport fuel consumption. So if diesel consumption declines, biodiesel consumption also declines. And you can see it on the diagram. If you look at the green and grey lines, we've plotted ethanol alongside gasoline. And as gasoline demand declined, ethanol demand declined in unison. So that did mean that in the US, lower diesel demand meant lower biodiesel demand. The same occurred in the EU, though in the EU the rather aggressive increase in the mandates meant that the decline was not as sharp. But what about vegetable oil use in biodiesel? This is where it becomes very interesting. The diagram on the right shows you the monthly year-on-year change in US biodiesel by feedstock. The column on the left, where it says output, and I'm afraid this is very small, I hope you can see it, shows you the total change in biodiesel demand compared with the previous year. And you can see that due to the lockdown, total demand declined, total output declined. But when we look at the split between different feedstocks, what we can see is that the three feedstocks on the right, corn oil, yellow grease, and animal fats, their usage in biodiesel all declined quite dramatically. Now, why should this be? Well, corn oil is a co-product from the production of ethanol. As you can see on the diagram on the left, ethanol production declined, therefore corn oil availability declined. Yellow grease is what the Americans use for used cooking oil. And with people not eating out at restaurants so much, used cooking oil supplies also declined. Of course, you have used cooking oil at home from cooking at home, but it's not worth collecting. It's too difficult to collect your used cooking oil. Animal fats output declined due to disruptions at the slaughterhouses. COVID-19 spread very easily in cramped, dark slaughterhouses with itinerant workers, the workforces. And all of this meant the availability of these feedstocks was curtailed, which had the remarkable impact that soy oil consumption in biodiesel, which you can see in the second from the left, increased. In the EU, the situation was even more extreme. Again, used cooking oil availability declined, animal fats availability declined, but all of those under the EU's mandates get double counting, which means that when you use 1 ton of used cooking oil methyl ester, used cooking oil biodiesel, it counts as if you used 2 tons. Now, with used cooking oil availability down, this meant that any ton of used cooking oil had to be replaced by 2 tons of vegetable oils. And that meant that in the EU we saw an increase as well in vegetable oil demand for biodiesel, and also a large increase in palm oil usage in biodiesel. More area is being sown to sunflower than ever before, but nonetheless, with very bad droughts in Ukraine, we've seen output decline. For rapeseed, we've seen production remain about the same. EU production has maybe increased a bit, but due to the ban in neonicotinoids, yields have not been able to go up much for the last few years. And with weaker Ukrainian output, this has reduced rapeseed exports to the EU and will probably reduce rapeseed oil output in the EU. In addition, we're now entering the colder months where rapeseed methyl ester, rapeseed biodiesel has an advantage, and France has added to that by giving a 1.2 times benefit, not quite double counting, but 1.2 times benefit to rapeseed-based biodiesel. So, what does all of this mean for vegetable oil prices? Well, the remarkable thing is that the impact of COVID-19 on palm oil has really been very different from what you would have expected at the outset. Yes, COVID-19 reduced consumption of vegetable oils in restaurants and cafeterias and did reduce palm oil demand, but only in China and India, and only for about 3 months, coinciding with a period of relatively low CPO availability. COVID-19 led to lower diesel and therefore biodiesel demand, but in the EU and the US, vegetable oil use in biodiesel increased to compensate for the lower availability of waste feedstocks. COVID-19 caused difficulties with meat value chains, but it didn't reduce the soybean crush. And in fact, the major driver recently has once again been weather. The droughts in 2019, followed by the floods in 2020, have meant low Indonesian output of palm oil. In fact, if we look at the diagram on the left, which shows you the spread of palm, rapeseed and soybean oil over crude oil, you can see that right now we're at price premia very similar to those of 2016 after the major El Nino weather event of 2015, which also brought very bad droughts. The big difference, however, this time around, is that whereas in 2016 rapeseed oil and sunflower and soybean oil availability were good, in this case we also have poor sunflower and rapeseed production, in particular again due to droughts in the Black Sea region. And the result of this really is to keep prices elevated over the next 6 months. There are fundamental reasons to support the prices where they are currently. However, there is a warning signal flashing here. And that is when you look at the palm oil, as well as the other vegetable oils, premium over crude oil, they are at really incredibly high levels. Now, they've been at high levels for long periods in the past, but I would say that the level that they are at currently does suggest that they will have to come down at least moderately over the near-term period. The issue here is whether biodiesel programs can continue to be funded at these extremely high costs. And we're already seeing Brazil, Argentina declining the volume of biodiesel they're using. We must keep an eye on the Indonesian BPDPKS fund. It in particular is very, very important for vegetable oil demand, and they are suffering from the very high spread at the moment. Nonetheless, coming back to the question with which we started, against all logic, it does appear that palm oil and other vegetable oil prices really are supported by the fundamentals at the level at which they are currently. Thank you very much for your kind attention.
Right, that was the session on the virtual POC or the Palm and Lauric Oils Conference. If you want to catch the entire thing, just head on to Bursa Malaysia Derivatives website or go to Bursa Malaysia website. There's a lot of interviews and also conversations like this that took place over there. Also, you can watch these kind of interviews on astroawani.com. Look for Notepad. A lot of interviews like this can also be found on that site as well. For now, thanks very much for watching and goodbye.